Picture this: a modest home in the suburbs of Phoenix, barely renovated, built in the 1980s, listed today for nearly $1 million. In Miami, a two-bedroom condo that was worth $300,000 in 2019 now sells for over $600,000. Families desperate to own are maxing out their credit cards, draining savings, and locking themselves into 30-year mortgages at interest rates above 6.5%. It feels like wealth. It feels like prosperity. But what if it's just a mirage? For months, mainstream headlines have been filled with two conflicting narratives. On one side, the housing market is cooling, prices are stabilizing. On the other, inventory is still low, home prices are resilient. Which one is true? The uncomfortable reality is that the U.S. housing market today looks eerily similar to every bubble in history. Prices detached from fundamentals, buyers driven by fear of missing out, and policymakers trapped in a corner. In this video, I'll break down the latest numbers from July and August 2025 that show where the market actually stands. 5 undeniable bubble signals most experts avoid talking about. Why this is not a repeat of 2008, but potentially something more dangerous. And finally, what you can do to protect yourself, whether you rent, own, or invest. Welcome back to Ascend Your Mind. Decode the markets. Protect your future. Section 1. Where the market stands right now. According to Redfin, the median U.S. home price in July 2025 was $443,471, up about 1.2% year over year. On the surface, that doesn't look alarming. But here's the catch. This is the slowest pace of growth in nearly 2 years. The S&P CoreLogic Case-Shiller Index confirms the trend. National home prices grew just 1.9% to 2.1% year over year, down sharply from the double-digit surges we saw in 2021 and 2022. And for the first time since the pandemic boom, cracks are visible. 7 major metro areas, San Diego, Miami, Phoenix, Dallas, Denver, San Francisco, and Tampa, are already posting annual price declines. In Denver alone, nearly 34% of listings cut their asking prices this summer. That's the highest share in the country. At the same time, inventory is creeping back. Redfin reports that the number of homes for sale nationwide is up 7.2% compared to last year. That's still below pre-pandemic levels, but the shift is meaningful. Sellers who once thought they could command any price are now forced to negotiate. Mortgage rates hover around 6.5% to 6.7% for a 30-year fixed loan. That's down slightly from last year's peak, above 7%, but still double the rates people locked in before 2022. For buyers, the monthly payment on a typical home is now the highest share of income in modern history, over 40% of median household earnings. In short, the housing market is stuck. Prices too high, borrowing costs too high, and wages far too low to keep up. That's the textbook setup for a bubble. 5 signals of a bubble. No one wants to admit signal 1, prices detached from incomes. Historically, the healthy benchmark is a home price equal to 3 to 4 times household income. Today, in many U.S. metros, the ratio is 8 to 10 times. In San Jose, median household income is around $130,000. The median home price, $1.4 million, more than 10 times income. Even in Austin, homes are 6 to 7 times income, far beyond affordability. When prices decouple this dramatically, it's not sustainable. It's speculation. Signal 2. High rates without price correction. Typically, when mortgage rates double, demand collapses and prices fall. That's what happened in 1981 and again in 2008. But this time, despite rates climbing from 3% to above 6.5%, prices remain stubbornly high. Sellers are locked in. Millions refinanced during 2020 to 2021 at record low rates and refuse to sell, artificially choking supply. This isn't stability, it's a dangerous freeze. Signal 3. Wall Street landlords. Private equity firms like BlackRock and Invitation Homes have purchased tens of thousands of homes, turning them into rentals. In some markets, institutional buyers account for 20% or more of all sales. That transforms housing from a basic need into a speculative asset class. When big players dominate, Volatility increases because their exit strategies can crash local markets overnight. Signal 4. Household debt explosion. American household debt just hit $1.2 trillion in credit card balances, the highest ever. Add auto loans and student loans, and the average household is carrying a heavier debt burden than in 2007. Delinquencies on credit cards and auto loans are rising fast. Mortgage delinquencies after years of record lows are now ticking upward. That's a classic red flag before downturns. Signal 5. Dangerous psychology. Prices only go up. The strongest bubble indicator is mindset. Across TikTok, Instagram, and even dinner tables, young buyers still hear, "If you don't buy now, you'll never be able to afford it." That fear of missing out fuels reckless purchases, stretching finances, skipping inspections, waiving contingencies. It's exactly the mentality that drove the dot-com bubble, the crypto bubble, and the housing bubble of 2006. Put these 5 signals together, and you see the outline of a market on shaky ground. Section 3. The social strain behind the bubble. Beyond the numbers, there's a human cost. According to a July 2025 survey by Realtor.com, nearly 70% of renters under age 35 believe they will never be able to afford a home. That's the highest share ever recorded. When an entire generation loses faith in home ownership, the cornerstone of the American dream, that's not stability. That's desperation. Meanwhile, homeowners who bought at peak prices are already feeling the strain. Zillow estimates that 2.8% of mortgaged homes are currently underwater, meaning the mortgage owed is higher than the home's value. It might sound small, but it's climbing every month. History shows, once the share passes 5 to 6%, foreclosure waves tend to follow. Then there's the rental market. With Wall Street firms scooping up supply, the median U.S. rent hit $2,150 in mid-2025, up nearly 25% since 2020. For many households, rent now consumes more than half of take-home pay. When people spend that much on housing, they cut back on everything else: travel, dining, even basic health care. That slows the entire economy. This is the irony of bubbles. They feel good for a while. Rising prices make homeowners feel richer, but beneath the surface, inequality widens, debt piles up, and the system becomes brittle. And when it finally breaks, it doesn't just hurt speculators. It punishes everyone. Why this is different from 2008. Back then, the crisis was triggered by subprime lending. Banks gave mortgages to borrowers with no income, no jobs, and no assets. When defaults exploded, the system collapsed. Today, lending standards are tighter. Most mortgages are to borrowers with decent credit, but risk comes from a new mix. Prices at record highs, rates at multi-decade highs, consumer debt exploding. Think of it this way. 2008 was a bomb that detonated instantly. 2025 looks more like a time bomb with a long fuse. And here's the scarier difference. In 2008, the U.S. government had room to bail out banks and households. Debt to GDP was under 70%. Today, national debt is over $34 trillion, nearly 130% of GDP. That limits how aggressively Washington can rescue the market. So no, this is not 2008, but it could be worse. A drawn-out stagnation like Japan's lost decades, where housing doesn't collapse overnight, but grinds down prosperity for a generation. Who gets hurt first? If the bubble bursts, or even if the market stagnates, some groups will be hit hardest. First-time buyers, millennials, and Gen Z, already stretched, will be underwater fastest. Renters, Wall Street landlords raise rents, tenants get squeezed. Small investors, leverage will wipe them out. Regional banks, rising delinquencies could sink smaller lenders. When these dominoes fall, the ripple hits everyone. Spending shrinks, jobs are lost, recession follows. 3 possible scenarios. Scenario 1, sharp correction, prices fall 20 to 30%. Millions underwater, foreclosures spike, housing drags economy down. Scenario 2, inflationary rescue Fed cuts rates, government stimulates. Prices don't crash, but inflation reignites, USD weakens. Scenario 3, Japan-style stagnation, prices flatten, not collapse. Affordability terrible, growth slows, ownership locked out for a generation, likely for 2025 to 2030. The ripple effect, Beyond housing bubbles never stay contained. When they deflate, the shockwaves ripple far beyond real estate. Take banks, for example. Regional lenders are heavily exposed to mortgages and construction loans. If defaults climb, these banks face rising losses. We saw this dynamic earlier in 2023 with the failures of several mid-sized banks tied to commercial property. A housing downturn could easily trigger the same domino effect again, except this time in the residential sector. Then there's Wall Street. Homebuilders, mortgage-backed securities, and REITs are all tied directly to housing. If prices slide, these assets will follow. In 2008, it wasn't just homeowners who got burned. It was pension funds, hedge funds, and global investors holding trillions in housing-linked securities. And don't forget politics. Housing is the single largest expense for most Americans. When people feel locked out of the market, anger builds. That frustration can shape elections, shift policy, and even destabilize governments. A market that once symbolized the American dream can quickly become a political nightmare. That's why the housing bubble isn't just about real estate. It's about the stability of the U.S. financial system, the economy, and the very fabric of society. What you can do. What should you do? Don't FOMO. Renting may sting, but buying at the peak can ruin you. Diversify. Don't put all wealth in real estate. Hold cash, gold, silver. Watch signals, delinquencies, foreclosures, unemployment. These warn before collapse. If you must buy, choose markets with strong job bases, infrastructure, population growth. Avoid speculative hotspots. Housing is not just an investment, it's where you live. A safe, stable home matters more than bragging rights. So, is there a housing bubble in America? The truth is, yes, but it's not the kind that bursts overnight. It's slower, more insidious, squeezing families with high prices, high debt, and high uncertainty. The question isn't if, but when and how it deflates. And when it does, will you be scrambling or prepared? The wealthy already know. They don't just hope for the best. They plan for the worst. And when the storm hits, they turn crisis into opportunity. If you found this video valuable, subscribe and hit the notification bell. In my next episode, I'll share 3 strategies to protect and grow your wealth when the housing bubble deflates. You don't want to miss it. And remember, decode the markets, protect your future.